Okay, discounted free cash flow provides a fairly useful model. Again, I don't think it's as useful or practical as the ROPE model, and it's definitely not considered to be. Research has shown that the ROPE model is a superior model. Nonetheless, for certain situations, discounted cash flow may be preferable. And really, you're probably wondering, well, what am I supposed to do? Because we're going to be doing 4 chapters here on valuation. We're doing 3 chapters, and then we're doing one on some additional things that you can do for valuation, because valuation is so important. What do you do when you're actually doing this in the real world? You really want to do all this, because this is real money. You know, you could be making a decision to invest millions of dollars of money, and not all of it is yours, it's other people's money. And so you probably want to do all of this. And when you're studying a company, when you're researching it, it may be your full-time job to research just a handful of companies. And so you're going to develop spreadsheets to do all of these other things. And then as you receive new information, when companies make earnings announcements or quarterly announcements come out, then you're going to sit down with your spreadsheets, make all kinds of changes, and come up with more accurate analyses. And this will help you keep making decisions and provide advice to others on how to make good decisions. So the discounted cash flow model assumes that the value of the firm is based on the present value of the expected free cash flows. And what expected free cash flows are net cash flows from operating activities minus capital expenditures, certain capital expenditures. We'll talk about that in a moment. They don't include financing activities because financing activities don't come from operations, obviously. Rather, financing activities are monies to and from investors and creditors. And so financing activities really are not that relevant. They're relevant in a different way towards valuation. What we're trying to do in valuation is determine what the stock price should be. So what the discounted cash flow model does is it really focuses on operations and how to use information about operations to estimate the value of the stock. So the commonly used definition, and there are other definitions that are used, some companies have very specific definitions that they try to encourage analysts to use, would be net operating cash flows minus capital expenditures. You know, I say net operating, and it doesn't say that here. It's just a technicality. When you look in the statement of financial statement, the statement of cash flow, you always say net operating cash flows or net cash flows from operations. So it says here, operating cash flow is not equal to net cash flows from operating activity reported in the statement of cash flows because the latter begins with net income, which includes both operating activities and non-operating income and expenses. So in certain cases, what you may need to do is may need to take net operating cash flows from the cash flow statement and adjust it for certain non-operating items. Non-operating items like interest income, sometimes dividend income, and interest expense are the 3 key items that are included in the cash flow statement but would not be included in free cash flow. And the textbook here gives you a different definition, and what they do is they take EBITDA, so earnings before interest and taxes, adjusted for non-cash revenues and expenses, subtract taxes, subtract investments in working capital, and subtract capital expenditures. So they use this other measure of doing it. I happen to like using the cash flow statement, but this book defines these in a slightly different way, which should give you mathematically an equivalent value, and that would be NOPAT minus the increase in net operating assets. And it's a parsimonious way of doing it. Parsimonious meaning simple and easy and cheap. And this way because once you've calculated, it's a lot to calculate NOPAT. We've talked about that, and especially that tax piece of NOPAT is very complicated right now. So for purposes of the book and how we're going to do things, because we're being consistent with the book here, we're going to do things as NOPAT minus NOA. However, if I was doing this in the real world, what I would do is I would do net operating cash flows plus or minus adjusted for any financing cash flows. I'll call them non-operating cash flows. So sometimes you may have interest income, interest expense, and sometimes dividend income, depending on what the dividends are on. If the dividends are on financial assets, investments, then they're non-operating. If they're on operating subsidiaries, which may be sometimes be the case, then they would be operating. You got to be careful. And then minus capital expenditures. And what I mean by capital expenditures there, what I mean by capital expenditures here is not just spending money on expansion, on new equipment, but specifically it's capital expenditures to maintain your current size, not capital expenditures to grow. So, for example, if you're looking at an airline, you may want to see how many aircraft they disposed of during the period and how many they purchased. And if they purchased a lot more than they disposed of, then you would need to adjust the capital expenditure figure equivalently. So that's on a practical basis how you do it. But for purposes of the book, it's fine to use, and I would encourage you just to use this simple definition that they have, because we're always going to be calculating NOPAT anyway. So your steps are to forecast and discount free cash flows for what's called the horizon period. That's the period over which we can reasonably make these estimates. And at the end of the horizon period, you have what's called the terminal period. That's the end of the horizon. So for example, if you estimate that you can predict free cash flow for 5 years into the future, then your horizon period would be 5 years. And then the terminal period would be at the end of 5 years. Then you discount all of these to the current time period, and you add up the present cash flows, present values of all of them. Step 3 is to summarize, to sum up the present values of everything, and that's going to give you a firm value. If you subtract net non-operating obligations along with non-controlling interest, that's going to give you the equity value, because that's really what you're interested in. And if NNO is positive, you're going to subtract it. If NNO, non-operating activity, is negative, that means it's like an asset, then you're going to add it. And then you divide this equity value by the number of shares outstanding to get your estimate of the stock. So this sounds like a lot of work. This is what the spreadsheet looks like again. So here your horizon period is 4 years. This is Procter & Gamble. And then you have your terminal period at the end of 4 years. And we take NOPAT and NOA, net operating assets, and we compute based on our forecast. Then we compute the increase in NOA. So our free cash flow is NOPAT minus the increase in NOA. So in this case, you have 11,032 minus the increase in NOA of 229 would give you free cash flows of 10,803. Then we take the discount factor to get the present value. And this would all be as of 2016, the present value. We add it all together. This is the 36,925 is the sum of all the present values for the horizon period. The terminal free cash flow, the present value of the terminal free cash flow assumes payments of 11,060. So that would be an annuity based on a perpetuity. And that would give you firm value of 278,208. Now, we have here a positive net non-operating obligations, NNO. So we're going to subtract that. We also have a non-controlling interest. We're going to subtract that. So firm value is the entire firm, but there are also non-operating obligations, and those don't belong to the equity holders. That's debt, really. So that's why we subtract that. And we get firm equity value of 265,158. Now that's the value of all the stock. You divide by the number of shares outstanding. In this case, 2668. It's really millions, so it's $2,668,000,000. And you get stock value per share of $99.38. And that's how you would go about doing the calculation. It's very complex, but the reward from doing this is that you can make good investment decisions, and therefore, by making good investment decisions, you make more money, so to speak. Now, in case you're wondering where we got this return, expected return, the weighted average cost of capital was computed as, and this is just a review of the previous chapter, we had a return on debt of 1.26% and a return on equity of 5.27%. They also have preferred stock, which is slight, and we weight each one according to the formula that was in the previous module. So, and here you can see the computations of how they did all of these. And again, I should have made this clear earlier. Weighted average cost of capital, I did mention this, but I want to emphasize it. Weighted average cost of capital, which we get from this computation, it was explained in Module 12, is 4.8%. And that is the discount rate that we use when we determine this. Because we're trying to look at the total firm value. So we need to take a weighted average of cost of capital related to debt, equity, and even this little minuscule sliver of preferred stock. So this provides a fairly practical model for estimating the value of the stock. Out of curiosity, I decided to look at the stock price for this year for Procter & Gamble. They were doing this analysis in 2016, and if you see, the stock price is in the 80s. This was July 2016. I probably could have done a whole chart for you, but I didn't. Anyway, so you can see here if the stock price is 85, and your analysis shows that the stock is worth 99, then this stock is a buy, because you're buying something for $85 that appears to be worth $99, and therefore this is something that you would want to do. Now, you could take the DCF model and you can tweak it in ways in order to get a more accurate measure, or perhaps less accurate depending on, but there's a lot of assumptions that go into this. So what you want to do is you want to tweak your assumptions. There's a lot of money at stake, and your entire career is at stake when you're doing this. So obviously you want to get as accurate a model as possible. So these are some of the things that you can do. You can focus on the horizon period and see if maybe you should increase your horizon period a few years so that your terminal period is later on. And that may give you a more accurate measure. Now that means, of course, that you have some information that would help you to provide a more refined, that help you to develop a more refined model. Also, your growth rate. This assumes that your growth rate increases to 2%. You can change after the year 1. You can change your growth rate every year. And as you add more, as you extend your horizon period, you can manipulate your growth rate from one period to another. You focus on your financial statement forecasts. You can refine those forecasts and come up with better and better measures, which again are going to give you a better and better valuation. Now, terminal growth rate, it oftentimes can have a big influence on your overall estimate. So you got to pay careful attention to what their terminal growth rate is and what you think, how much you think the company is going to grow 5 years and after that into the future. So you really got to estimate that well, because it has a big influence on what the overall value of the stock is. Now, your prices, what you want to do also is you want to see how sensitive $99 is to certain measures. So we made certain assumptions when we were developing our weighted average cost of capital. For example, when we look at debt, we're looking at existing debt, but reality is this may be variable debt, or the company, this may be what they pay now, but if they were to borrow more money, they would have to pay a higher rate. Or there could be other things that are influencing how we measure this. We might have used a shortcut to measure the cost of debt, whereas we could use a more refined measure. So what you might want to do is look and see how sensitive your conclusion is to different assumptions that you've made. So one example is manipulating your growth rate. I don't know what the growth rate is going to be. So what would different numbers come out with different growth rates and different weighted average cost of capital? So if I assume my weighted average cost of capital is 480, and which I think it is, I don't know why these numbers all of a sudden got so low, and then I lower my growth rates, then how is that going to influence these different valuations? So here's the numbers you have, and we're thinking that if the market value is in the 80s, right, then if your weighted average capital went up to 5.3 or 5.8, then this isn't a good investment anymore. Similarly, if your growth rates increase to 2 or even 3%, then this becomes a much, much better investment, and with a lower weighted average cost of capital, this actually becomes a much better deal. The same with NOPM and NOPAT, net operating profit margin and net operating asset turnover. We calculated these based on financial statements, but the reality is that they may change in the future. So how would your stock valuation change? So what you can do is you can plug different numbers into the model and come up with different estimates of what the stock price should be. And you can see here that as we change all of these things, see, I got a stock value here of $99, and then suddenly, I don't know why all these numbers are all so low. They may be, I don't know, I assume they did everything right in the textbook, but you get the idea that by manipulating some of your inputs, you can see how that number changes around. Because the reality is that in the future, things are going to change, and your estimates are probably not going to be correct. So what's going to happen when different things happen? How's that going to impact your stock value? And here you can see more analysis of how NOPM, they're changing these now in terms of percentage, net operating profit margin. These are just more experiments with different NOPM. And the easy way to do this is just change the numbers in your spreadsheet, but there are more sophisticated ways to do it in Excel that you can reproduce and manipulate and go back and figure out how you did everything when you want to tweak things further and check your work. One issue is that whenever we're using this valuation model, we're always assuming year end. So when we did this, we assume that everything happens at the end of the year. And that's a problem because we're not always at the end of the year. So there's something called a mid-year adjustment. And what we could do is we could assume that payoffs occur evenly throughout the year by adjusting the present value terms. Now, one thing that students like, well, I don't know if students like to do it, but I think it's a handy tool, is to do what's called reverse engineering. Students like to do this with homework. Is they look at the homework assignment and they look at the chapter, and then they go back and forth and they try and figure out how's the homework different from the chapter, and how can I reproduce what's in the chapter on the homework assignment and figure out what the answer is. Instead of just doing the problem, it's just easier to, I think, read the chapter and then do the problem. But a lot of students like to reverse engineer it instead, and that's great. What you would do with reverse engineering is you would basically take this, input the current stock value, let's say it's $85, and then figure out what the variable would be. I would look for the return on investment, in other words, the discount rate. So you would figure out your discount rate that would make up your discount factor, and what discount rate would be needed in order to get the stock value. And the function for that in Excel would be internal rate of return. So Excel makes this very easy. Some students like to do it by trial and error, but really internal rate of return, IRR, I believe is the Excel formula that you would use, and that will give you your interest rate, and then you can compare that to the weighted average cost of capital and the expected return on equity. So reverse engineering is a handy way to figure these things out and say, okay, am I comfortable with this rate of return, rather than focusing on stock price. So the discounted cash flow model is one of the most frequently used models. It's one of the things that I'm going over here because I think it's so important. And what you need to do is you need to discount the future cash flows from the business. Now you need accounting numbers to do that. You could either use NOPAT, or you can use net operating profit, net operating cash flows from the cash flow statement with the adjustments that I've gone over. But there are big issues here, and one of them is what's your forecast horizon and what's your terminal growth rate. What you would see is an overall your terminal value. If you run this analysis, you would discover that this terminal value, because the present value of the terminal value is so high, 241, it comprises most of the firm value, and therefore it overwhelms your estimate. So if your terminal period valuation is inaccurate, then that's going to cause your stock value to be inaccurate, and therefore it could cause you to make a bad investment. Okay, next we're going to go over the next module, which is 14. And module 14 looks at the ROPI model, operating profit.